The state of the commercial real estate market has become a growing concern for the economy. We had Home Depot co-founder Ken Langone on yesterday. He spoke about this great unknown on Squawk Box.
The next big shoe to drop is commercial real estate.
Yeah.
How much do we know is, commercial real estate is what? Rent rolls, occupancy, vacancy, and so forth. We don't know any of that yet. We do know there's a lot of people that have significant exposure to commercial real estate, and we don't know how that's going to play out.
Joining me now is Marty Cohen, co-chairman and co-CEO of $18 billion real estate firm Cohen & Steers. Mr. Cohen, thanks for joining us.
Morning, Joe.
We have now heard again and again and again about the next shoe, and it's commercial. Although yesterday, watching this network, people made the point that there isn't overcapacity like there was in residential, and that this has to do more with asset price devaluation. Will that help soften this, Marty, or is it going to be bad?
Well, we wind up in the same place, essentially. You add to that the recession, which is essentially a lack of customers, whether they're for expanding office use or malls. So we wind up in the same place. Unfortunately, the deflation in real estate values make loans that were made, we call them the more recent vintage loans of 06, 07, a lot more shaky than ones that were made before, when we had this spike in real estate prices.
So these are like individuals that have upside down mortgages?
They're kind of like that. The difference is that in many respects, and this maybe get to your first point, these buildings are still servicing their debt because they're generating cash flow, and the interest rates are relatively low on many of these. It's when they come due that we're going to see issues. And, a lot of people have talked about this shoe to drop, but nobody's really quantified it. There's a few $100 billion of commercial real estate loans coming due over the next 3 to 4 years. Now, we don't assume that all of those loans are bad and go to zero. There's going to be a percentage that are bad, and there are many that are going to be refinanced or extended. I'm not as certain as some people are that the dimensions of this are unknown. I think they're relatively known, and if the economy can get on a better footing and capital begins to be available, which I think it's starting to already, we could talk about that as well, particularly in the REIT industry, then I think that the problems that everybody's waiting for may not be as severe as the worst prognosticators are suggesting.
Hey, Marty, it's Doug. Good morning. How are you, pal?
Good, Doug.
It's not only, I think, from the standpoint of investors, it's not only the couple $100 billion that matures in the next 2 or 3 years. It's that there's approximately $3 trillion of debt on the commercial property in the U.S., and that compares to about $900 billion only in the last cycle 17 years ago. So it's a combination of the rollover and the existing debt. There are two scenarios. You muddle through, or we have a double dip in the economy. How do you play both scenarios in your sector?
Well, let me talk about our sector for a minute. Essentially, we had a bear market that lasted about a year that brought the REIT market, or real estate investment trust market, down about 30%. We thought that was pretty typical of a bear market. Then when the credit markets collapsed following the demise of Lehman Brothers in the fall, we had a margin call basically on every asset in the country. Commercial, residential, you name it. Anybody that had debts outstanding was subject to basically problems with repayment. The interesting part of this for us is that the public market is where the capital is available. We believe that the cure for over-leverage is not re-leveraging, but adding equity. What we did at Cohen & Steers is we decided, since we're charged with investing on behalf of our clients, we only wanted to invest in companies that could use equity capital to see them through this recession and this dip we have in markets, and emerge from that as very, very strong companies. The recapitalization of the industry has now added about $13 billion to the industry, has put the vast majority of companies on great footing for the next period in the cycle. And I don't know whether we're in a double dip or I can't predict that, but what I can predict is that those companies that are well capitalized, phase one is to take advantage of opportunities that will clearly surface as others can't repay their debts or are forced to sell. And that creates a growth profile for a lot of companies, the largest companies in the industry. After that, the economic situation with zero new construction anywhere in any asset, any property type, as the economy begins to recover, and I don't know whether it's 1, 2, whatever, then you'll have the second wave of profit growth as fundamentals start to improve. We think we're at the beginning. We call it starting over and now survival of the fittest. We think that is where a lot of money is going to be made in real estate. So there's a lot of barriers to entry into this market. And it's funny, 2 years ago, a lot of real estate people were just, fighting over assets at prices that were double what they are today. And today, everybody's trying to get rid of them. I see that as a great opportunity.